Hey everyone, it's Eric Green. Want to say hello to everyone in our tax rep community. And I want to talk to you about our sponsor, Call ENQ. And I'm going to just say this, we would not take any sponsor or any product that we do not use ourselves. If you listen to episode 36, Dialing for Dollars, I discussed kind of how we discovered this. It is amazing. It is literally changing the way we practice in our office, right? What Call ENQ does is, you're sick and tired of waiting, right? 30 minutes, 45 minutes, an hour. You finally get through to the IRS. Their system is down. They can't help you. Sometimes they just hang up on you, which is always fun. And then you have the problem is, do you charge the client for this or do you not, right? It's not the client's fault. On the other hand, it's not your fault. Call ENQ says they will get you through to the IRS in under 3 minutes. We are averaging 30 seconds. When we talk about saving in our business, time is money, right? We think projecting now for the month we've been using this, if we project to a year, we will probably save $50,000 of billable time, right? That is a lot of money that we'd love to have fall to our bottom line. Okay? And I'm sure our clients would rather not pay for. So with that, I'm going to put a link below. Go check out Call ENQ. It is a fantastic service, and I'm telling you, we negotiated for ourselves to get a free 100 minutes as part of our deal with them. All of our tax rep members will get 100 free minutes. You can check it out. You have nothing to lose and a lot of time and money to gain. All right, go ahead, check it out. Log into the forum. Let me know what you think. Hey everybody, it's Eric Green. This is episode 37, Why We Love Payroll Tax Problems. Okay. This is a topic that comes up a lot. And basically what I wanted to tell you is we love payroll tax problems. Payroll tax problems are basically the number one reason why small businesses will end up in your office. Okay. Let me explain. When you're a small business, then the amount of compliance, right? Sales tax, payroll tax, your own income tax, estimated payments probably, or if you're on the payroll, running your payroll, all right? The bookkeeping, and that, by the way, is not even what your business is about unless you're an accountant, right? Your business is about carpentry or car repair or engineering or architecture, whatever it is you do, running a restaurant. So inevitably, as their cash flow dips, right, up and down, the payroll taxes that are withheld from the employees don't get into that separate account or don't get sent over to the government. But don't worry, next month will be better. And then the next month, and then the next month. Meanwhile now, failure to deposit, failure to pay over, failure to account, failure to file. All the penalties begin, getting ratcheted up until eventually what happens. And if you listen to the episode with Paul Mamo, who's the director of collection, he talked about how they're trying to get out ahead of the payroll tax problem. Right? There's that knock at the door. Revenue officer sitting there. Darren Guillot, the director of field collection, may be with him. Darren loves whenever he's out in an area, he goes out on field calls with the revenue officers. He wants to see what's going on. Right? They're going to be knocking at the door. They're going to want to talk to you about your payroll tax depositing. And all of a sudden, everything comes home to roost, and the number is simply too big. Right? This is when tax rep members really earn their money. And there's a lot of money in payroll tax problems. We have a company that needs to get into compliance. We have an individual owner that needs to get into compliance. So back bookkeeping, payroll tax returns, income tax returns. We need to deal with the collection issue on both the company and on the personal side. There may be a trust fund assessment against multiple people, multiple owners, maybe the bookkeeper inside the company who has signature authority. This suddenly becomes a very big octopus to have to fight with many different issues going on. So on the one hand, you sit there and I feel bad for the client. On the other hand, and the left side of my brain is saying, "Oh my, that's too bad," while the right side of my brain is making those little registered cha-ching noises, right? Cha-ching, cha-ching, because this is where we earn our money. Okay. And these are complicated cases. All right. They're fun cases, I think. Now, the first thing we need to do, of course, is figure out, is this business even a viable business? Right? Let me just tell you something. I'm just going to cut to the chase. If you have a business, a client who has a business, and that business cannot pay its payroll tax and that business cannot pay its sales tax, that is not a viable business in its current form. And what the revenue officers are going to tell you, and they're absolutely 100% right, if you can't stay current, shut down. Get out of business. You have to go get a job. You cannot run a business stealing the government's money. Now, are there things that can be done? Are there some changes? Very often these kind of problems force the owner to confront issues. Okay? They force the owner to confront issues that they've never had to confront before. And in fact, I'm just finishing up a book by Bedros Keuilian, Man Up. And he talks about how sometimes you have to get knocked down or have those issues when you can actually, what he calls man up, and this isn't meant to be sexist, man or woman up, and come to grips with what's really going on and deal with the problem that you may have been avoiding or skating around, ignoring up until now. So the first thing you need to do when that client comes in is we do the consult, right? We charge for the consultation. I sit there. Do you have a viable business? Inevitably, everyone starts off the following. It's a really good business. Well, why are you here then? Right? I mean, you're here for a reason. And what I love this is, we're about, last year we didn't pay the payroll taxes. We owe the government about $150,000. But this business makes me about $90,000 a year. Really? Okay. Well, let's look at that. All right. It's $150,000 you ran up last year. If we pull off the penalties and the interest, it's really about $100,000, let's say, of tax. But yet you earn 90 and you didn't pay the taxes. Had you paid the taxes, you would have lost 10,000. How is this a good business? And they'll sit kind of open mouth like they'd never thought about that before. It's not such a great little business if it can't pay its bills. All it is bleeding cash. And by the way, now you're responsible. I mean, a bad business is one of the few assets that is actually, when it goes toxic, can actually destroy all of your other assets. Right? I mean, you have a bad stock, the stock gets wiped out, it has no value, you're out the money in that stock. A bad business, you're now personally on the hook for this. So not only is the asset gone, but now you have to use your other assets to pay off the liability created by the bad asset, the business. Right? So the very first thing you're going to be doing, right, is do we even have a viable business? Is this business worth saving? Right? Now, interestingly, for those of you who are tax rep members who are thinking about it, we have a master class on collection, and you can go take the master class. You can purchase it for like $250. Members get it for free, of course. It's in the members area. We're in the middle right now. I'm in the middle of recording a master class on payroll tax issues. Okay, this is such a hot area in IRS collection right now. That I think this is something you're going to want to watch, because this is a lot of what comes in the door. Small businesses that owe money. All right. Those small Schedule C, small partnerships, small S Corps or C Corps, those are the ones they owe money, and they can't pay it back. And usually by the time the IRS has caught up with them, they're unable to unbury themselves. Right? Paul Mamo, when he was on, if you go back and listen to that episode, Paul and I discussed that. Okay. And he said, this is a major problem for the IRS. This is a problem they're trying to get out ahead of, right? With their early EFTPS alerts, right? Those automated phone calls and emails they're sending out to business owners saying, look, We've noticed you haven't been depositing. We've noticed that you haven't filed your return. The hope being that they can get out ahead of it and stop it before it becomes such a mountain that they can't recover the money. Now, so the first thing, of course, is, do we have a viable business? Now, the next thing is, okay, let's say we determine with some tweaks, all right, this is a viable business. This is why it's so expensive. We need to deal with collection on the business, and inevitably there's going to be a trust fund. Unless we can pay the trust funds off immediately, there's going to be a trust fund assessment against the responsible owners or employees. So let's walk through that a little bit. First step, of course, is assessment against the company, right? There's going to be the billing notice. There might be the CP 504 threat to levy. Then there'll be the final letter 11 or CP 90 or letter 1058, depending where it's coming from. It'll probably be a CP 90. And the reason I say that is normally with payroll issues, you have a revenue officer in the field assigned, and they use the form CP 90 for their final notice. We may have to request a collection due process. It may already be past that. They may already be levying the company. Right now, all right. So you have the company, and if it's viable, we need to work out a payment arrangement on the company. Well, how do you know what to pay? Right? I mean, you got this company, and the company's, let's say the company is netting $150,000. You can't pay $150,000 now. Assuming if it's a corporation and the owner is already on salary, well then yeah, the net income would. I mean, now it's easy, right? C corp, the net income, pay it over to the government through an installment agreement, and you're done for the company. But what if it's a Schedule C or a partnership? That net income is the income of the owner. So how do you know what the company can pay? You've done a 433B, right? That's the collection form for the company. So you've gone through this, you've got a P&L and all the bank statements and maybe the leases and any other loans. You've got all the documentation. You've got your beautiful little pretty package, and it shows a net income of $100,000. Revenue office, this is great. Start paying the $100,000 over. We'll set it up at, I don't know, what does it come to, like $8,500 a month, somewhere around there? And the owner said, whoa, wait. I got a mortgage to pay. I got bills to pay. You can't, where I'm going with this is you can't figure out what the company can pay until you do the 433A analysis on the individual, right? So for instance, that 100,000, what if the individual, when you do the 433A analysis, the collection form at the individual level, well, what if that shows that the owner needs 72,000, 6,000 a month to pay their bills? Well, that would leave about 28,000. I would expect a revenue officer to say, look, let the company start paying at 28,000. We're going to assess the trust fund against the owner. We'll get to that in a minute. And then, we'll make the owner uncollectible, right? I mean, they don't have any money left over, and we'll get the payment plan on the business. So I mentioned C Corp, right? If they already have a salary and there's 30,000 left, that's easy. Well, you're still going to have to do the 433A analysis, and here's why. How do we know it's a reasonable salary? For collection purposes. I'm not talking about, economic, analysis for, in the corporate arena where we look for reasonable salary. That's not what I'm talking about. What I'm talking about is pure 433A straight up analysis for collection. How do we know if the salary is reasonable, right? What if it's a $250,000 salary? You still need to do the 433A analysis. And if, let's say that shows 100, you're paying yourself 250. Well, 100 is all you need for the 433A. Guess what the revenue officer is going to say? Drop your salary to 100. Or let's say there's 30,000 on the company. We'll take the 30,000 left in the net income on the company. And Mr. Personal Owner, we're going to assess you. You get to keep 100. That other 150, you're going to pay it as an installment agreement against the trust fund. They'll set up an agreement for the company and for the individual. Right? Right? So that's the straight up, right? It's a viable company. We're going to just, and there's nothing to fight about, right? One owner, S Corp, let's say, we're going to set it up as an installment agreement, and we're done. So you have to do the company, you have to do the individual. Any missing returns have to be filed. Right? I'm recording this now in the month of October. Should have made your first 3 quarterly estimated payments, assuming you're not on payroll. You need to make your first 3 quarterly estimated payments. Do you have your bookkeeping done? We got to get the bookkeeping done for this year. These matters are, like I say, from our perspective, extremely lucrative because you're representing the company and you're representing the individual owner, right? So you got 2 powers of attorney. We have to do the 433A analysis on the owner. We got to do the 433B on the business. We got back bookkeeping that may need to be done, any missing returns, right? 6 years for compliance purposes. We got to get the company and the individual owner into compliance. It's a lot of work. It's a lot of money. Now life gets interesting. There are 3 partners. It's a partnership and there are 3 of them. Are they all responsible? Here's where it gets interesting, and I want to warn you about something. So the 3 partners come in, everyone's friendly. Yeah, no, this is bad. We got to deal with this. We got to deal with this. Yeah, we're all responsible. We really are, right? Everyone's friendly. And then you start doing the analysis and they realize what they're going to have to pay. And all of a sudden, everyone's not so friendly anymore, especially when they go home and they tell their spouses. And the spouse hits the roof. Why are we paying this? You were out in the field selling. You were the one bringing in money. Joey was the one in the office. He's responsible. And now everyone's pointing the finger at everybody else. What I want to warn you about, when you've got a payroll tax problem with multiple owners, there is a significant potential conflict of interest. Circular 230 tells us if you are enrolled to practice before the IRS, which means you are an EA, a CPA, or an attorney. There's also a qualified appraiser, but I'm not worrying about appraisal issues right now. But let's say you're an EA, a CPA, or an attorney. What Circular 230 tells us, what it tells us is you cannot take representation of 2 or more taxpayers where there is reasonable belief that there will be a conflict of interest. Now, if they all come in and they're like, look, we were all signing this, we were having meetings with the accountants, we all knew about it, we're all screwed, we're all in. You still want to get them to waive it. Because remember, when these problems come up, it's not going to be now, it's not going to be next month, it'll be 2 years from now when an attorney calls you and says, yes, CPA Jones, this is Attorney Green. I understand you represented Mike Smith, my client, in this trust fund thing. Yep. Oh, yeah, no, you good. You remember? And you also represented, Jim Jones, the other guy. Okay. My guy wasn't signing checks. Why didn't you raise that as a defense? Don't you think you had a conflict of interest in this situation? And now your blood runs cold because now you're thinking about a couple of things. 1, malpractice, and 2, what he's about to say next. You don't think this is a violation of the ethics code, or the Office of Professional Responsibility wouldn't be interested in this? What the attorney is doing is very underhanded, but it's common. And what they're doing is they're leveraging the Office of Professional Responsibility, meaning the people who can go after your license, to get you to roll over and pay this because his client doesn't want to. So even where they both come in, you need to make sure you get the conflict out there and waive. So what we would do in our retainer agreement is say the following. We understand, based on our meeting, that you both have accepted responsibility for this and neither of you plans to raise a defense. And then in bold, and this is all in bold and underwriting, in the event one of you should decide that you intend to raise a defense, we would be in a conflict, we would have a conflict of interest and would therefore need to withdraw, and both of you would need to go seek independent representation. By signing the letter below, you are agreeing that you are aware of the potential conflict, that you have told us that there will not be a conflict, and you are waiving You are confirming our understanding and effectively waiving this. Now, if there's a conflict later, you still need to withdraw, but at the very least, you got them both to sign off that you told them about it and that they're aware of it. But that is one of those areas where in trying to help people, you may end up getting burned yourself. So you need to be very careful when you have multiple parties involved. And this happens a lot. We have the owner, and then the employee calls and said, I was only following orders. Can you help me? No, I can't. I'm sorry. I'm representing the owner. You need to have your own independent representation. Right? So the last thing I want to talk about on the podcast, not the last thing, but one of the last things, okay, is the following. So now they've come through, they've assessed the company, they propose an assessment against the responsible people. Now, I did a podcast about why you never sign the 4180. The 4180 is the interview form. You never do the 4180 interview and you never sign the 4180. All right. And by the way, the revenue officer doesn't like that. All right. But when this happens, what we do is we will send the 4180 to our client, have them fill it in. Okay. And then we will go through it with them, and based on the interview, we do the 4180 and have them sign it, and we will send it in. Here's why. Some of the questions are extremely broad. In Section 2, letter C, there's a question, for instance, that asks the following. Were you responsible for preparing, filing, reviewing, and paying, it's or. Were you responsible for preparing, submitting, reviewing, or paying the payroll tax returns? Well, what if you prepared them, but you didn't have signature authority and you weren't in charge of paying them? How do you answer that question? It's a yes, no. Right? And what most people say, well, yeah, I prepared the form. What the revenue officer does is they hear yes, and they check the box yes. And then later on, when you're in my office with this happened, $250,000 assessment, and you and your wife is crying, and you're saying, yeah, but I prepared it, but I didn't. Now we have an uphill battle, and we go to appeal. We file the way you challenge it. We filed out as to liability offer, which is a form 656L. If you've never done one before, has nothing to do with ability to pay. It has to do with your providing evidence that you're not responsible. So we submit all this, and now the battle begins. Your client said yes, Eric. They sat there. They were represented. They had a CPA or an EA with them. They signed the form. It says yes. And this is what I'm fighting against. And I'm trying to explain to them, my client would have signed anything to get out of there, right? You're in this little pre-World War II conference room in a folding metal chair where they're sitting there saying, you did this, here, sign here. What does the person do? They sign. Why? Get the hell out of there. And then the bill comes. Don't do the form. Don't take the interview. We want your client to come in for the interview. Yeah, no thanks. Now listen, they are entitled to do the 4180. We do it. How am I going to answer that question, Eric, if you're so smart? Easy. I'm going to write no. I check the box now and I write in there, see attached. And I attach a statement that says, though the taxpayer was responsible for preparing the form, they did not have signature authority. They sent it to, and I named the person they gave it to, and have no knowledge about whether it was ever paid or not, because they had no bank signature authority, nor do they have any access to the bank account. I want all of that in the 4180. Why? Because if I go to appeals, we never agreed we were responsible. And that's what I'll do. You could say, well, Eric, you should have said yes because you did. You know what? I'd rather default to no and explain it. Why? Because they can never say, yeah, but you said yes. No, I didn't. We said no. And by the way, I've had other practitioners who listened to that 4180 interview podcast. If you haven't listened to it, go back and listen to that episode. All right. I had other practitioners come to one of the live talks we gave at Quinnipiac Law, and he came up to me and said, I had this case, and I did a FOIA, and I was going to do an offer and compromise. So I did a FOIA on the administrative file, and I found the 4180, and boy, they didn't like you. He said they threatened to summons whenever. Did they ever summons? Nope. They threaten it all the time. They're not going to summons. Why? They have the information. Now, let's just go one more step. Let's say they do summons your client. Let's say they summons my client. No, Eric, he's got to come in for the interview. What am I going to do? I'm going to have my client sit there and read the 4180. That's what I'm going to have them do. And if they say, well, I think the answer should be yes, we're going to refuse. They can't make you sign. Refuse. I'll have them arrested. They can't do that. The IRS revenue officer had no authority to arrest anybody. All right. They'd have to forward it over to the criminal investigation unit. And by the way, if criminal investigators show up at the door, you can explain, we did the 4180, we submitted it. They then wanted us to change our answer and threatened us with criminal prosecution if we didn't. If that actually happens, you call TIGTA, the Treasury Inspector General for Tax Administration, and you file a complaint against that revenue officer because they're in violation of the law. Right? They cannot sit there and try to intimidate your client into signing something that your client does not believe is accurate. Okay? But anyway, let's table that for the moment. We don't do the 4180, we submit it. But you know what? Screw it. Our guy's responsible anyway. Okay? Let's just go with that. In fact, we don't even have to do the 4180. Sole shareholder, it's him. He's responsible. All right? Let's just get past that. Well, out will come this letter 1153, and the letter 1153 says, we believe you are because the above named company, which they have toward the top of the letter, has failed to full pay its payroll taxes. We are recommending that you be deemed responsible. Congratulations. And now you can pay the bill. And then it goes through how to protest. You have 60 days to file your protest. And then with it will be a form 2751. And that form is a waiver form. It'll break down the trust fund penalty, and then your client can just sign. With one minor exception, you never sign the 2751. Now, I know many of you say, well, Eric, you just said, yeah, your guy's responsible. Screw it. We're responsible, right? Yeah, so we're responsible. Let's just sign it and be done. No. Why? I have 60 days to file an appeal. I'm not going to, but I've got 60 days. That's a good amount of time to work on the offer. Shut down the company. I mean, what are we doing here, right? If the company's viable, then we got to work on an installment agreement. I got to get a 433A and a B, all of the attachments. By the way, I might want to do some offer planning, right? Or even installment agreement planning. My guy doesn't have a car. It's a broken car. He's got kids. He's got no life insurance. He doesn't have health insurance. I'm going to go line all that stuff up. I need that 60 days. And by the way, it's a lot longer than 60 days, right? 60 days, then the billing notice comes out. We ignore it. Not ignore it, but we don't do anything. Then it'll come out CP 504. They're about 30 days later. Certified. About 45 days later will come the final notice. So that's now about 6 months. Closer to 5 months. Let's say I file the appeal. That'll take another few months. I may be able to get my client 8 to 10 months before the rubber meets the road. We can make all of our financial moves during that time. So I don't sign the 2751. I'm going to take the 60 days, thank you very much, and use that to start planning. Maybe I have to get my client into compliance, right? I told you we're recording this now in October. What if my client can't get into compliance? He doesn't have the money to make up the 3 quarters, right? Or he can't make up the back payroll deposits, right? Although October already, you're only 1 month into the 3rd quarter, you should be able to make that up. But let's say it's December, we can't. I may have to get past this, get the returns filed, and then start fresh, for the next quarter or next year. I'm going to take that 60 days because I need it. Now, I did tell you there's a caveat, there's an exception to that. And what is that exception? That exception is the following. I'm going to go do an offer. I had a restaurant client. The restaurant failed. I'm going to do an offer in compromise. I pull transcripts and I realize there's about 2 quarters. The last 2 quarters don't show up as assessed for the trust fund. I call the revenue officer, David, who I love. He's a great guy. David said, "Oh yeah, you know what, Eric? I haven't gotten around to it. I mean, he's out of business. You know, I'll get around to it." I said, "David, I want to do an offer for this guy." David, being very sharp, said, "Oh, you're not going to be able to until those periods are assessed." I said, "Exactly. Can you just fax me over the 2751s? We're just going to sign them." He said, "You know what, Eric? I'm out in the field tomorrow. You'll have it the next day." And sure enough, over comes the fax. Get the client in. I don't do it myself because I don't want to be second guessed 2 years from now. Well, why did you agree to that? He had a defense. Client comes in, or I scan them to him, signs them, we fax them in. Now they're assessed, or will be shortly. I can go ahead and file my offer. Because if I don't do something, collection may start on the other periods. Right? And if I do that, I will include copies of those 2751s in the offer package. So those goobers at the centralized offer and compromise unit don't say, "Oh, gee, we don't see this and the system is assessed." And they kick the whole thing out and keep my client's money. I'll say right in the letter, we signed the cover letter, right? We signed the 2751s for these last 2 periods. Copies are enclosed. They should be assessed in the system by the time you get it. If not, please follow up with the revenue officer, but we signed the 2751s. Other than that, though, I want that 60 days. So what can you do with payroll tax debt? The same thing you can do with income tax debt. Well, you can't go bankrupt on it, but you can compromise it. You can do an installment agreement. Taxpayer may be deemed uncollectible. I've had a business deemed uncollectible that owe payroll tax. I've done offers on existing businesses. Very difficult to do. The IRS doesn't like them for obvious reasons, right? We're going to compromise right off a debt. You get to keep the business, which might be worth money at some point, right? It's a touchy thing, but it is possible to do a compromise on an existing business. I have done it, all right? Again, not easy, and it tends to be a business which is really more of a service business. Anything that has any valuable assets becomes difficult because, do we include the assets? Do we not include the assets? Normally what happens with business assets for an offer is because they're necessary, they can't include the value and include the income stream they generate, right? It's not fair to the taxpayer. So it's one or the other. Normally what they'll do is the IRS will say, look, try to go get a loan. If it's generating income for the household, go try to get a loan against the assets. And if you can get a loan, we'll allow the loan repayment as a monthly expense. Nobody loans against used equipment nowadays, all right? So they inevitably get rejected, and we include the rejection letters. Now, if the business is doing nothing but losing money, now it becomes a different issue. Because if it's not really generating income, aren't you better off to go get a job? And let's just sell the assets, and then they may want the value of the assets included in the offer. Now, that may not be much, so it may not be an issue, but where you have a client that has valuable equipment, construction equipment, other things, if that business is only losing money, you're going to have an interesting argument about the value of the assets because the IRS may view it as they're better off taking the assets. They're not generating an income anyway. But then you go about resolving the tax debt the way you would any other way. Now, with payroll taxes, let's just wrap this up quickly. There are sort of, some options with this, some strategies. One is you can shut the business down, right? It gets reduced to the trust fund, right? Which is the personal liability piece against the responsible people. The thing I want to tell you about shutting down the business, there are a couple things you need to keep in mind. Number one, there is a lien that has arisen against the business, even if the IRS did not file the notice of lien. A lien arises by statute upon demand for payment, retroactive back to the date of assessment. Okay. And I've had clients tell me, oh, they didn't file a lien. They don't have to. It's there by statute. Therefore, those assets in the company, those aren't the taxpayers' assets. Those toys now belong to the government. And taxpayers will say this, let's shut the company down. I'm going to take the trucks. I'm going to retitle them. No. They don't belong to you anymore. Right? But we can deal with that, right? Form 14-135, we request a lien release. The government doesn't want the trucks. They want the money. Go out, get Kelly Blue Book. The truck's worth $5,000. I'm not going to offer $5,000 on an offer. They'd only take 80%. I'm going to offer $4,000, maybe even a little less. Right? And you make an offer to the lien, you fax it to the lien unit, Form 14-135. Companies undone, out of business, have a pickup truck worth roughly somewhere around $5,000 according to Kelly Blue Book. The owner would like it. He's offering $4,000. Almost inevitably, the IRS, as long as it's a reasonable offer, I find the IRS lien unit accepts it. They'll send you a letter that says, upon receipt of certified funds, they've got to be certified, we will send a release to the owner. So they will the lien stays in place. They release the truck out from under the lien. They're not releasing everything from the lien. The lien stays on everything else. But that truck, when they get the money, they'll let the truck go. So we can clear the assets out from under the lien. The other thing is, if your client comes to you and says, look, I want to try to save the company. I'm going to borrow money from mom and dad, and let's make a nice payment, right? I'll send in a payment, show good faith. Well, let's talk about that. How does that work? Let's assume the company owes $100,000 in payroll debt. When you add interest and penalties, it's now up to around $160,000. Of that $100,000 of payroll debt, roughly $65,000 will be trust fund, the amount withheld from the employees, right? The income tax withholding and the FICA withheld. Why 65%? That's something I just made up, but over 20 years of doing this, it's my general observation that it usually ends up around there. Could be a little more, could be a little less, but that's about where it is. So 65,000. Guy said, look, I'm going to borrow from mom and dad. I'm going to send 50,000 in as a good faith payment. Now, if we just send in the 50, the government will apply it in its own best interest. Non-trust fund first, penalties and interest. So the whole thing on the company goes from 160 now to 110. If the company fails, my client still owes 65,000 for the trust fund. Now, what if we take it and we request it be applied? Under Revenue Procedure 2002-26, the IRS, if you send in written instructions on how something is supposed to be applied, they are required to apply it that way. This is how, if you owe back taxes, you can still make your estimated payments for this year. When you send it in, you're sending it in with the 1040 ES, and you're writing in the memo section, at least you should, 2018 1040 ES. You're giving them instructions on how to apply it. So now we take the 50,000 that mom and dad loaned us, and we send it in, with a letter that says, here's a payment meant to be made against the trust fund portion of the taxes owed for the following entity with the ID number for the following periods. And we also write in as much of that as we can in that memo section. So now, same thing, the company comes down to, from 160 to 110. But now if the company ultimately fails, my client doesn't owe 65, he only owes 15. And if it's a voluntary payment from the responsible person, you are allowed to do that. What you can't do is have the company make payments and try to apply them against the trust fund. The IRS won't allow that. Right? The company can only make payments against its liability, not the owner's liability. All right, so we can shut the company down. Just remember to deal with the asset issue and get the lien cleared. We have the issue of making, making payments and prioritizing them against the trust fund. So at least if all else goes to hell, our client gets to get up and walk away from it. Right, and of course, third strategy is where you have someone who you don't believe is responsible. So the last thing I want to talk about on this podcast is protesting. the liability. And again, I mean, we're going to do an entire thing just on protests. But basically, you build the case for why your client shouldn't be responsible, right? And I've had some tremendous success in this area. We do a lot of this. Bookkeeper. Bookkeeper gets paid $2,000 a year. She shows up every Friday, updates the books for the week, cuts all the checks, signs them because she has signature authority, and then calls Mike. Mike is the owner of the company. He has 3 different construction crews. They do work for franchises, right? So you're slapping up a new Taco Bell. There's Mike and his crew, and they come and put up the Taco Bell in like 6 hours or whatever. She calls Mike every Friday. Mike, you got $12,000 in the bank. You got $25,000 of bills. Who do you want to pay? And Mike would sit there and say, pay this one, don't pay this one, pay this one, don't pay this one. She mails out the ones that are supposed to be paid. The rest of them she sticks in the drawer. IRS comes in, does an assessment, finds her signature authority over all the checks, assesses her as responsible. As you can imagine, she and her husband freak out when they get a bill for $400,000. Come to see me. We're walking through this, and I got to tell you, I'm thinking this is a brutal case. I mean, she signed everything. She had signature authority. She knew the taxes weren't being paid. I said, you know, when you would call Mike and he would say, pay this one, don't pay this one, where was he? Oh, he's out with the crews. I said, are there people, like, are there managers or supervisors? She said, yeah, it went really true. Do you think they witnessed this? She said, yeah, probably. So she puts me in touch with the 3 supervisors who all tell me the exact same story. They're present when she would call on a Friday, and Mike would say, yeah, pay this one, don't pay this one, pay this one, don't pay this one. I get affidavits from them. We describe this. I also raise the issue. It's a $1.5 million construction company. She makes $2,000. Do you believe that somebody making $2,000 is running a $1.5 million construction company, that her signature authority, she doesn't really wield any kind of functional authority. She does not actually have the authority to determine who gets paid and who doesn't get paid. Her signature and her doing the checks is for the mere convenience of the owner. And therefore, it can't be willful, because she couldn't decide on her own to pay the taxes if she wanted to. And in appeals, that ultimately carried the day, and we got her cleared. Right? So I just wanted to let you know, signature authority in and of itself is not the end-all be-all, but you need to build your case. That's why I love these cases. They're interesting, they're challenging. You need to be able to build the case. This is where, if you're not a lawyer, you get to play lawyer, right? Talk to witnesses who were there, all right? Get the bank statement, see who signed the checks, all of that. They're very fun cases, right? And again, remember, we're doing an entire master class on this. So go check that out in the members area. My final thought on this, right, before I let you go, couple things. Be wary of getting signature authority. If you're listening to this as an accountant, you do not want to be able to sign checks for your client. And never, never let a client use a signature stamp. That is asking to be robbed, all right? And it happens a lot, right? We see an awful lot of people ripped off by their bookkeepers. If you want to Google it, go Google Rebecca Block. I think I can put, I don't know how many links I can put under the podcast, but I'll try if I can to put another one on. My client was robbed by Rebecca Block of Windsor, Connecticut. I hope everybody who knows her hears this. She stole about $200,000 of payroll tax money, which she used to fund her lifestyle. Didn't need it, just wanted it. And was sentenced to a year and a day by Judge Underhill here in Connecticut. Good for Judge Underhill, right? But we brought that case to criminal investigation, right? She had signature authority, and he was not watching what she was doing because he trusted her, and he's out selling. As a matter of fact, when I brought that case to Scott Reynolds, who's one of our criminal investigators, who's a friend of mine, Scott looked at it. I remember he said to me, he said, you know, I'm disappointed, Eric. I was like, I got very offended. We did all this work. We basically did the audit. I mean, we handed it to him. I said, why? He said, you did all the work. There's no fun left. Right. But they took that case and ran with it, and they prosecuted him. Right. Do not let your clients and you yourself, do not ever use a signature stamp. Nobody else should have signature authority other than the people, the owners, or the people who must, number one. Number two, if you're an accountant, you do not want signature authority. Every time I do this program, I get bombarded with questions that say, I prepare the 941s and I go online and I submit them for the client. And if there's not enough money and my client's falling behind, am I responsible? As I mentioned, it's a functional test. Do you have signature authority for the company? Are you making decisions on who gets paid, who doesn't get paid? Most of the accountants say, no, I don't. Only the client does. Then you're fine. The fact that you are merely processing, right? My company, let's say, doesn't pay the payroll taxes. They can't go after ADP, right? It's not ADP's fault. No one at ADP has signature authority over our bank accounts and decides who Jeff and I pay and don't pay, right? Be leery of being given that kind of authority. All right. It may be convenient. You may think it'll help things. You're asking for problems. All right. So with that, this is why we love payroll tax cases. They're involved. They're exciting. They're interesting. There's a lot of really cool moving parts. If you haven't been through it, go check out that masterclass, which should be done in the next week or two. Lord knows I've given enough webinars on payroll taxes. I'm sure you can go find one, but the masterclass will be up. It's all updated, including exhibits and examples. I think you're gonna find it very illuminating. All right. So everyone, keep plugging along. Thank you for tuning in on the podcast. Again, I'm Eric Green, and if you're not a member of Tax Rep, I don't know what you're waiting for, but it's time to start building your practice. All right. Have a great day. Hey, everybody. I hope you enjoyed this episode of Tax Rep Network podcast. Listen, there has never been a better time to build a representation practice, right? The 1040 business is not a growth industry right now. With more than 14 million accounts in the collection division inventory and more than 7 million non-filers that the IRS has identified and going to begin going after, this is the time when your skills are needed. Worried you don't really know what to do, think you need training, think you need coaching, think you need somebody to back you up. That's what Tax Rep is, right? Come join our community, begin building your practice, make more money, add 100,000 or more to your bottom line, and know that you've got us watching your back. You have questions about a case, issues with marketing, how to market, you want to use our marketing materials. It is all there for the members in our site. All right. So come check us out. We'd love to have you join us if you haven't already. Right. Keep building on your practice. Keep helping taxpayers. Have a great day.